But if you see the 10-year Treasury going below 4, staying there, you're going to see mortgage rates starting to drop from there. But what we're concerned about too is the Federal Reserve. What's the Federal Reserve going to do in 21 days when they meet? Well, they focus in on inflation. They focus in on the jobs reports. Well, all the numbers so far are dismal. As long as inflation doesn't spike, okay, you're going to see rates continue to drop down. That doesn't mean mortgage rates are going to continue. Here's some catalysts that I want you guys to focus in on, and tune in every day because I'll give you this data. But we want to watch 2 points right through here in the Treasury market, because we don't have a lot of financial data to figure out where inflation is going in the jobs markets. So let's start looking at some technicals when it comes to the bond market. So what we're seeing right through here, the bond market, this is the, hold on through here, this is the 30-year Treasury. Now, it's not your 30-year mortgage. This is a 30-year Treasury bond that trades on Wall Street. The yield right now is 4.7, okay? We don't want this to exceed 5. And it seems like it has a point where it really goes to 5 and then drops back down, and then 5 and drops back down. It doesn't hang on there for quite amount of time. That's one pivot point we want to focus in on. That's on the upside. On the downside, we want to look at right through here is the 10-year Treasury. Now, there's an interesting trade right through here. We've been teetering around the 4% mark for a while, well, above 4, but there's a mark right through here at 4%, and it dropped down there briefly when the Federal Reserve cut rates. But if you see the 10-year Treasury going below 4, staying there, you're going to see mortgage rates starting to drop from there. That's going to signal to the markets, okay, the bond market's doing pretty well right now. Start buying bonds. And so here's how the bond market works.